Welcome to Synthetic Alpha AI, where artificial intelligence meets institutional trading. Let's decode the market.
There is no building, no trading floor, no opening bell. And yet, this market moves more money in a single day than most countries make in an entire year. So where does it actually happen? Who's really in control? And why do prices move before the news even hits your screen? By the end of this video, you'll understand the real structure behind the world's largest financial market, the part almost nobody explains correctly. And the final piece is the one that changes how you'll see every price movement from now on.
Most beginners picture Forex as a single place, a screen, a price, one market moving up and down. But that picture is wrong. Forex isn't one market, it's a network. Banks in London, trading desks in New York, institutions in Tokyo, hedge funds in Singapore, all of them quoting slightly different prices at the same exact moment. There is no single authority setting the real price. Instead, prices are agreed upon moment by moment through thousands of separate transactions happening in parallel. That's why two brokers can show you two slightly different numbers for the same currency pair at the same second. Neither is wrong. They're just reflecting different corners of the same decentralized network.
Here's where most beginners get it backwards. They assume retail traders, people like you watching this video, move the market. We don't. Retail traders make up a small fraction of daily volume. The real weight comes from three groups. First, central banks. When a central bank changes interest rates, it doesn't just affect one country. It reshapes global capital flow instantly. Second, commercial banks and institutions. These are the desks executing massive trades for corporations, hedging currency risk on international deals worth billions. Third, hedge funds and large investment firms. These players often trade on information, positioning, and algorithms most retail traders never see. Understanding this changes everything. Because now the question isn't what does the chart say, it's what are the biggest players positioned to do?
This is the part almost nobody explains correctly. You've probably seen it happen. News breaks, and the price barely reacts. Or worse, it moves in the opposite direction of what the headline suggests. Here's why. Institutions don't wait for news to be published. They position themselves based on probability, economic data trends, central bank language, and market expectations well before the official release. By the time the headline hits your screen, a large portion of that move may have already happened. This isn't a conspiracy, it's structure. Large players have access to faster data feeds, deeper analysis teams, and earlier positioning windows than individual retail traders. That doesn't mean retail traders can't succeed. It means understanding why price moves matters more than reacting to headlines after the fact.
Forex is famous for one thing. It never sleeps. But here's the misconception. It's not one continuous, uniform market for 24 hours. It's actually 4 overlapping sessions: Sydney, Tokyo, London, and New York, each with different characteristics. During the London and New York overlap, volume and volatility often increase because 2 of the largest financial centers are active simultaneously. During quieter Asian sessions, movement can be slower and more range-bound. This is why the same strategy can behave completely differently depending on what time you trade. Most beginners never account for this. They apply one approach at every hour, then wonder why results are inconsistent.
Here's the mistake we promised at the start. Even experienced traders often think of price as something that moves because of technical patterns, support, resistance, trend lines. But patterns don't move price. Order flow does. Technical levels matter because enough participants believe they matter, not because there's some invisible force at those price points. Support and resistance are a reflection of collective behavior, not a guarantee of future movement. This distinction is subtle, but it's the difference between trading reactively and understanding the why behind every move.
So here's what actually defines the Forex market. No single location, no central authority, a network of participants operating across overlapping sessions, driven by probability and positioning, not certainty. Understanding this won't guarantee results. No education can promise that. But it changes how you interpret every candle, every headline, every level on your chart. Which part of this surprised you the most? The fact that institutions position before the news? Or that support and resistance aren't as fixed as most tutorials suggest? Let me know in the comments.
Until next time, stay patient, stay disciplined, and trade with Synthetic Alpha AI.